Hey, welcome back. So, when you sign that giant stack of paperwork for a mortgage, you're probably just thinking about your new house, right? But what you might not realize is that your loan is about to go on this incredible, kind of secret journey through the entire global financial system. Today, we're going to follow it.
So let me ask you this. You've just promised to pay back a lender for, say, 30 years. But is that lender the one you're going to be dealing with for the next 3 decades? Well, spoiler alert, probably not. And why that is? Well, that's basically what makes the entire modern financial world go round.
All right, let's get into it. The whole journey kicks off the second your loan is created, what the industry calls origination. And right from the get-go, your lender has to make this one critical decision that basically determines everything that happens next. Yeah, that's right. Your loan doesn't just get stuffed in a filing cabinet somewhere. The lender, whether it's a huge bank or a small mortgage shop, has a fundamental choice to make. Are we going to hang on to this thing and collect your payments for 30 years, or are we going to sell it? This one choice is the big fork in the road for your mortgage.
And this decision leads to 2 totally different models. On one hand, you've got portfolio lending. This is the old school way of doing things. A bank makes a loan, they put it on their books, and they just keep it. But the other path, originate to distribute, is the real game changer. Here, the lender acts more like a factory, just churning out loans with the sole purpose of selling them off to someone else. And this is the model that completely dominates the market today. Why? Because it lets the lender get their cash back right away to make more loans, and it spreads the risk out.
So if most lenders are just selling these loans, who's buying them? Well, it's actually not that simple. You can't just sell one mortgage at a time to a big pension fund. The system is built on something much, much bigger. And this is where your individual loan goes through this, well, huge transformation. And that transformation has a fancy name, securitization. I know, it sounds super complicated, but the core idea is actually pretty straightforward. Think of it like this. Imagine thousands of tiny little streams. Each stream is a monthly mortgage payment from a homeowner like you. Securitization is the process of building a bunch of financial plumbing to gather all those thousands of streams together into one giant, powerful river of cash flow. This new river is called a mortgage-backed security, or an MBS, and that is what can be sold to big investors all over the world.
And you can really see just how dominant this whole process is when you look at this chart. That small slice there, that's the share of loans that are actually kept by the original lender. The vast majority are bundled up through securitization. You see these huge chunks handled by government-sponsored groups like Fannie and Freddie, another big piece by Ginnie Mae, and then a smaller slice by purely private companies.
But here's a key thing to understand. Not all these mortgage-backed securities are created equal. They really exist in 2 different universes, and the difference comes down to one crucial word: guarantee. In one world, you have agency MBS. This means if a homeowner stops paying, a government-sponsored entity or the government itself steps in and makes sure the investor doesn't lose their money. This makes them super safe. And then there's the other world, non-agency MBS. Here, there is no safety net. If borrowers default, the investor takes the full hit. This is the world of jumbo loans, and it's also where you used to find all those infamous subprime loans back in the day.
So let's zoom in on that safe world for a second. The biggest players here are Fannie Mae and Freddie Mac. Now, technically, they don't have an explicit government guarantee, but everyone kind of knows the government would bail them out if they got into trouble, which, of course, is exactly what happened in 2008. They mostly buy up standard, conforming loans below a certain dollar amount. Then you have Ginnie Mae. Ginnie is different. It guarantees securities that are backed by FHA and VA loans, and its promise is backed by the full faith and credit of the U.S. government. That makes it about as safe an investment as you can find on planet Earth.
Okay. So we've seen your loan get created, transformed, and bundled. But the journey's not over. Where does it actually end up? Who, at the end of the day, owns a tiny little piece of your monthly mortgage payment?
The answer is pretty much everyone with a lot of money. Seriously, the list of buyers is a who's who of global finance. You've got commercial banks, insurance companies who need safe, long-term investments, and of course, pension funds and mutual funds that are investing our retirement money. You've even got foreign governments buying them up through the sovereign wealth funds. Your mortgage has officially gone global. But there's one buyer on that list who is totally unique: the U.S. Federal Reserve. The Fed is not in this to make a profit. It buys mortgage-backed securities during a crisis to keep the whole system from collapsing and to carry out its monetary policy like quantitative easing. This makes the Fed this incredibly powerful force in the market that's playing by a completely different set of rules than anyone else.
So the loan's been sold, the risk has been scattered all over the globe. Everything sounds great, right? Well, not so fast. Anyone who owns these things is constantly trying to navigate some really powerful and sometimes hidden financial currents.
For any of these investors, it really all boils down to 4 main types of risk that they have to worry about every single day.
And those big 4 are interest rate risk, prepayment risk, credit risk, and liquidity risk. So let's quickly break down what each of these means for the new owner of your mortgage.
Okay, first up, interest rate risk. This is like rule number 1 of bond investing. If you're holding a bond that's paying you 3%, and suddenly new bonds are being issued that pay 5%, your old 3% bond isn't as attractive anymore, right? So its price goes down. It's a simple seesaw. When interest rates go up, the value of existing bonds goes down.
Next, we have prepayment risk. This one is really unique to mortgages. See, as a homeowner, you have a kind of superpower. You can pay back your loan pretty much whenever you want. So what happens when interest rates fall? You refinance, which is awesome for you. But for the investor, it's a total bummer. They were counting on collecting, let's say, 6% interest for years and years. But now, poof, they get all their money back at once and have to find somewhere new to invest it, but at the new, much lower rates.
You know, Michael Lewis put it perfectly in his book, Liar's Poker. He said that when a homeowner refinances, the investor has been schmooked. It's just such a great way to put it. It perfectly captures that feeling of getting your money back at the worst possible time.
All right, number 3 is credit risk. This one is the easiest to understand. It's just the risk that the homeowner stops making their payments and defaults on the loan. Now, if you're an investor in one of those super safe, government-backed agency securities, you don't lose a lot of sleep over this. But if you're holding non-agency MBS, this is literally all you think about. It is, without a doubt, your single biggest worry.
And this risk is not some abstract theory. Look at this chart. It shows what happens to the rate of non-performing loans, basically defaults, during a crisis. You can see residential loan defaults spike, for sure. But look at commercial mortgages. That rate can just go through the roof. It's a very real reminder that when the economy sours, the danger of people not paying becomes incredibly real, very fast.
And finally, we have liquidity risk. This is the nightmare scenario where you desperately need to sell your investment, but there's nobody on the other side of the trade. The market just freezes up. We saw this in 2008, and we saw it again briefly in March of 2020. If you're forced to sell in a frozen market, you either have to take a massive, painful loss on the price, or worse, you might not be able to sell at all. So after following this whole crazy journey, what's the big takeaway here? It's that your one mortgage on your one house isn't just a simple loan. It's a tiny little cog in this gigantic, incredibly interconnected global machine that's built to shuttle money and risk all around the planet.
Now, this unbelievably complex system is the reason why mortgages are so widely available and generally affordable for so many of us. But it has a dark side. As we all learned the hard way in 2008, all that complexity can hide some truly terrifying risks that can threaten the entire economy. Which leaves us with the one big question we should all be asking. Have we actually made the system stable enough to handle the next crisis? That's definitely something to think about. Thanks for tuning in.